get ourselves going. Good evening, everyone, and welcome to our economic update and forecast. We haven't done one of these events in a number of years. There was a pandemic or something that kind of inhibited some of the activities that we're able to do. But we're very excited to have this event. It's a hybrid event, so we have many people who've joined us remotely in a hybrid way. And for those of you who are not as familiar with the firm as others, our firm has grown tremendously in the last several years. And part of that growth is that we've expanded our geographic footprint with our team in particular and our client base following there. So it's really important to us to create an experience for those who are not here in the local market to hear the conversation that we're having and feel that we're all part of the same experience. So you guys can all turn around. The camera's back there. I want everyone to turn around and wave to everyone who's online. There we go. So we are not alone. We have a really exciting program tonight. We have, and I'll turn it over to our moderators in a moment, but we're going to spend about 45 minutes with a panel discussion about the economy. I'm told it's not all bad news. Actually, I was told it's kind of good news. So we'll see what everyone has to say. And then we'll follow it up for about a 15-minute Q&A. And then anyone wants to hang out after that, the bar will still be around and there's food and such, and everyone's welcome to continue to mingle. The weather was, before this event started, there was 3 rainbows around our office. I don't know if that means anything. There was a hailstorm that came through. It's either magical or the end of the world. It's one of the 2 things that are going on. So we'll see where it takes us. But that's the story. For those who are online, any questions that you have, you can put them into the chat. We'll capture those and they will be curated and make sure they're captured into the Q&A. And for those in the room, obviously, you just raise your hand. So without further ado, I want to introduce David and Emily, who are in our resiliency task force. They actually lead our resiliency task force, which is a program that we had here at the firm, started when in about 3 years ago, February, March of 2020, when COVID hit, as we worked hard to really diagnose and understand the challenges that our clients had and have and how we can help them. And it's evolved as the world has evolved. And so we're excited here to take a look forward and talk about the economy. So David, Emily, I turn it over to you.
Thanks, Tom, and hi, everyone. And I think the rainbow is a positive thing, Tom. So I'm going to go with that. Maybe there's gold at the end of it, like, you know, for the economy. So there we go.
Well, so Jerry called it a good omen.
Yes, I love that. So hi, everyone. My name's Emily Mycelis. I'm a senior manager here at GHJ, and I'm in the profit participation service line. David Sutton over there is my co-moderator. He is a partner here at GHJ, and he is the private equity partner lead, basically. And we are joined by our wonderful panelists. So Rachel Foltz is a directing manager over at Endeavor Capital. Cameron is a managing director of Fifth Third Bank, and Stephen is the president and CEO of LA County Economic Development Corporation. So thank you all so much for coming, and we're really looking forward to this dynamic conversation. So we wanted to start off by talking about the global economy and how that growth or slowdown may affect the US markets. And the first question that I'm going to go is to Cameron. You're right in the center, so get ready for it. With interest rates increasing, how are you seeing a change between globalization and a focus on regionalization?
Well, I would say, and thank you for the great question. I would say that you've already seen a movement towards regionalization, and that has already affected interest rates. And you think about it, because more regionalization, more nationalism or isolationism that you see more inflation. And part of the reasons why, and part of the reason that you've got 2 different factors that contribute to inflation. You got goods inflation, which we saw last year that contributed to the extreme levels of inflation. And you've got services inflation, and that's part of the wages inflation. So when you have regionalization, you will have higher interest rates because you got to pay people more. When you have services inflation, and that's going to be very, very sticky and going forward, whether that continues to contribute to higher interest rates, I do think it will. And the Fed has sort of telegraphed that already, saying that we're going to tighten monetary policy as long as we have inflation above current level, above elevated levels. Their range, or their projected range for inflation, is 1% to 2%. And we're sitting at 5% to 6%. And what they're targeting is the Fed looks for a real Fed funds rate at 1.5%. right now, and what that means and how you calculate that is when the Fed funds rate exceeds inflation by 1.5%. Right now, we see Fed funds at 4.5 to 4.75 is the target range. And like I said, you're seeing inflation at 6%. That's a negative Fed funds target rate. And so they're going to continue to tighten monetary policy until they see that number flip. Now, when I say that number flips, I'm not saying they're going to wait until that number flips. It's telegraphed. So if we project 4% or 5% inflation by the end of the year, let's say 4%, then you're going to see us tighten monetary policy to 5.5%. So that regionalization that we've seen in the markets has caused interest rates to continue to rise. Now, that does mean for business owners and operators and foundations, I would say one opportunity that you see with higher rates, and you look at it from the asset side of the balance sheet, whatever excess cash that you have right now, and this could be personal too, you do want to look at short-term interest rates and short-term treasury yields, because those are you've got a rare opportunity, savings accounts or whatever have you, you've got a rare opportunity to invest for a short-term period at 4.8 to 5%. Just imagine what we saw prior to this at savings accounts, and some of them are still collecting zero right now, but savings accounts at 0%, to be able to collect and accrue interest at 5% for a 6-month, 7-8 month period. That's an opportunity for you to make a return on that excess cash that you have.
Thank you. Yeah, I agree. Does anyone else want to add anything, or should we move on? All good? Okay, Stephen, I think you got the next one.
Yeah, thank you, Emily, and thank you, Cameron, for the thoughtful answer. Tied to that is, or tied to inflation, one particular area where we've seen a lot of disruption last year is the supply chain. And I'll continue with the weather theme. We had some clouds in the supply chain last year, and maybe we've got a break in the clouds right now. And so, Rachel, coming to you with this question, how do you see the current state of the supply chain shaping the economic outlook? And that can be domestic supply chain, it could be international, inbound into the US. But yeah, how do you see the current state of supply chain and what that means for the economic outlook?
Yeah, thank you, David, and thank you for having me here. It's the supply chain situation has been absolutely fascinating over the last 3 years. And starting with the pandemic, you had people pulling back on inventory. Then in 2021, middling kind of buying of inventory combined with extreme demand. Then heading into 2022, you have extreme buying of inventory and wavering demand, and then excess at the end. And so it's just been a complete kind of uncertain environment, and for businesses a really hard thing to navigate, because for a while there, particularly in 2021 and 2022, the supply chain service providers, really the manufacturers and the shippers, really had the upper hand in many ways, and we're forcing, particularly in the mid-market businesses, to increase their minimums or pay more for freight with very little visibility. And now that seems to really be shifting on a broad basis, where while you have people working through excess inventory and maybe lowering their buys, and consumer demand feeling a little bit uncertain, hopefully businesses are able to take back a little bit of control by having more bargaining power on capacity with supply manufacturers. And then thankfully, rates for shipping have come way down and visibility has improved. So while it seemed to be doom and gloom for a period of time now, and so much uncertainty, it feels like there should be margin improvement opportunity, visibility improvement, and more control over inventory, hopefully coming into this next year in 2024.
That's the rainbow, right?
Add to that rainbow a little bit more. So all of you have been hearing about the congestion issue at the Port of Los Angeles, Port of Long Beach during COVID. So full disclosure, I actually used to work at the Port of Los Angeles, been screaming on top of our lungs for years, basically saying, hey, we need to invest in the infrastructure. This is one of the major markets. LA and Long Beach control 43% of all ocean going cargo coming into the United States. Please, if you want an efficient cargo movement system, you have to invest here. I don't know whether you guys know this, but the federal government distributes some of the maintenance funds and harbor maintenance funds. So we were told that for every dollar that's spent on the West Coast, about $7 is spent on the East Coast. So because we are controlling such a big portion of it, the taxes we generate go to DC and it gets redistributed in the East Coast. So we're subsidizing some of the other competitors. So you guys all heard about the congestion issue. Oh my God, there's 100 ships waiting outside the Port of Los Angeles, Port of Long Beach. When was it that you guys heard about that there were about 2 or 3 ships outside waiting? When we cleared the congestion issue, there weren't too many news coverage about that. It's all bad news, but when the good news comes, they don't cover it. I think it's important to celebrate the fact that we have gone through it, yet we're going to get into details. There are going to be more challenges, but at the same time, celebrate the little wins. Give us some credit here in Los Angeles for solving some of that issue.
Agreed. Go, Angelina.
Yeah, exactly. Anything, Stephen, to that point and talking about, the supply chain and how much global trade comes in Los Angeles. We wanted to know your opinion on what the outlook is for global trade and how will it influence the US economy if so much is coming in through here?
So when it comes to global trade, I like to separate it into import, export, and foreign direct investments. So when it comes to import, export, we talked a little bit about Los Angeles and Long Beach being this major markets. But don't forget, when it comes to international trade, especially when it comes to import, export, it's not just ocean going cargo. Air cargo counts as well. LAX processes over $160 billion worth of goods every single year through LAX alone. This is not counting Ontario and other entry points. So combined together, the Los Angeles Customs District is the #1 customs district in the United States with over $460 billion in two-way trade with the rest of the world. Good news.
Very good news.
Bad news, supply chain disruption has also created some changes in practices. As we're looking at international policies, the decoupling between China and US is not that relationship under the current administration is not improving, especially now that there's a potential partnership between China and Russia because of the Ukraine war. This will continue to tense up the relationship. And when the #1 and #2 economy in the entire world are at odds with each other, it disrupts the entire supply chain, especially since over the last 70 years, we've built our entire supply chain based on manufacturing in China. Yes, the labor cost has been increasing. Yes, they've been moving some of the manufacturing to other locations in Southeast Asia, such as Vietnam. But is that enough to basically very quickly change the entire model altogether? So there are a lot of uncertainties, including just locally. I think we haven't been talking much about this, but I don't know whether you know, but we're under a labor dispute right now and labor negotiation right now at the Port of Los Angeles, Port of Long Beach. We're hoping that they'll come to a happy conclusion, but it started in June.
Oh, wow.
So that's why the Port of Los Angeles, Port of Long Beach have recently fallen off the #1 and #2 spot in the nation that we've been holding that spot for many years, if not decades. And now New York, New Jersey just took over that spot. So I'm hoping that, eventually once the labor negotiation is finalized, then basically we'll bring back some of those cargo. However, the problem is this: in 2002, when we actually had a labor dispute and the port actually shut down the operation for a few days, 25% of our cargo, actually, the discretionary cargo, left this region and never came back. So we don't want that. We want to make sure that we have this, and that's why the request for the federal government to increase more funding to this region so that we can improve our supply chain is so important. The good news is it is coming through IIJA, through IRA, all these infrastructure bills that are coming through. We will have some possibilities of actually improving our efficiency, and by doing so, we can attract more cargo coming back in this region.
That would be amazing. I hope that happens. Yeah. So I think we've been pretty positive so far, and I don't mean to be a downer on the conversation, but economics are, the economists are predicting that there may be some kind of economic disruption in the next year or so. So for everyone watching and the people in this room, this question is for all of you. And Cameron, I'm going to ask you to answer first. Again, you picked the center seat, so you're in the hot seat. But what are your tips and tricks to advising folks in this room for sustainable growth? What are key areas to focus on and look to in the coming year?
Well, I would say, first of all, when we're talking about recession and you're trying to figure out the timing of recession, there's a lot of fear that goes around when we're saying the words recession. And part of the reason why is because of the last two recessions that we had, the global financial crisis and the COVID crisis. And we think recession, well, unemployment goes up to 10, 12, 13, 14%. The stock market tanks. Well, in this case, I think we need to redefine what we mean by recession. Recession just means a slowdown. Now, a lot of times we like to think it's 2 negative quarters, but we learned that last year that it's actually what the NBER determines is a recession, but it's a slowdown. And so the economy is going to ebb and it's going to flow. And so you've got to look at that and say, okay, what kind of recession will we have? I think right now we'll have pockets of recession where you have some industries that won't do as well. You'll have some industries that will navigate through the recession pretty well. The last two recessions that we had, virtually no industries really navigated through those. You were shorting everything in order to make a return. And so redefine what you mean by recession, and ways that we can navigate through that is to mitigate the risk where you can mitigate those risks. I'm on the financial risk management side of our business, and in rates, you're looking at right now fixed rates being lower than variable rates. You get some certainty there. You've got the euro and the US dollar being very, very strong. And so any folks who have global exports or global purchases can actually take advantage of cheaper goods right now before the market turns. You've got commodity prices that have been more volatile than they've ever been. You've seen oil go from $70 to $120 and then back down to, or actually $40 to $120 and back down to 70. So that kind of volatility, you manage through that. So you manage and mitigate the risk where you can. And like I said before, on the rate side, you've got a rare opportunity right now for that cash that you have on your balance sheet to generate a return. When you're looking at equity markets that are ebbing and flowing and as volatile as we've seen them over the past few years, you had that rise that we saw, and we're not seeing us hitting those peaks. Take advantage of that 5% that's in treasuries. And granted, you've got the debt ceiling debate that's going on, so you do have some risk to that, but you do have a place where you can generate 4 to 5% return. So take advantage of that and worry about other parts of your business that are more uncertain. So.
Thank you. Yeah.
I'm happy to chime in from my perspective. Sustainable growth. I think that's a very, very important word, and growth for the last 3 to 5 years. We've been in this weird bubble where growth is revenue growth. And for a lot of companies, it's not profit growth. There's been so many digitally native darlings that have been getting tech-like multiples and VC investments and rounds of VC investments, with VC firms whispering that you're going to be the next unicorn. And all of a sudden we've had a reversal of that. And it's so refreshing to see, okay, you need a proven business model and you need cash flow. And I love cash flow. But it's interesting in that sustainable growth means balancing top line growth with a healthy bottom line. And there's, the rule of 40, where if you add your top line growth and your bottom line margin together, should those equal 40? I think that's a pretty wise guideline, but I think it's management teams sitting down together and saying, what should we be scenario planning? What's a base level of growth? And what if we decline by 20% or 40%? What are our fixed and variable costs? And what is our go-to-market strategy? And where do we cut, or where do we invest if, we see more volatility than we're going to? And if we can't get access to capital markets on equity or debt, how do we kind of weather those storms? And those are the questions that I think teams need to be asking themselves. And hopefully it is a soft recession. It's not extreme measures. But hopefully we're getting to a more healthy environment, and a recession is never a good thing, but it can be a healthy reset in some ways, to really assess priorities, focus the team, and then come out better and take market share during that time.
Yeah, I love that. And I think that was one of the things we were thinking is, is it, is looking at something like a recession in such a negative way, is it really a healthy cleanse and really allowing companies to focus on the priorities? And I know, in the pandemic GHJ, we formed this task force and we looked at it, and, I think we came out way on the better side. Tom's right there. So he did a great job at leading us. So I definitely think it's, a healthy way to look at it. And Stephen, I just wanted to know if you had anything else that you wanted to add. I know that, you were talking about looking into government funds and items like that.
So right before COVID, we had a resilience pamphlet that we're sending out to small businesses, preparing for in case of disruption. And what we're talking about is at that point, wildfires, potential earthquake. Never thought about a pandemic, but we're saying, hey, you might want to consider making sure that you're able to work remotely. And have you heard of this thing called Zoom? And everybody's like, you guys are crazy. Why are you guys spending so much time on it? Of course, we now know about it. So the question for the group and to the audience on Zoom is this: do you think there's going to be another crisis that's going to be coming up ahead in the next 5-10 years, whatever it is? I think the answer is yes. So what are you going to do about it? So are you looking and doing a research in terms of one, technology that you guys will need in the future? How do you future-proof your organization? At the same time, what we've seen over the last 3 years is that there are a lot of potential government grants are available to support these businesses. But for a lot of small, medium-sized businesses, they're not ready to take advantage of that because they don't have their paperwork ready. They don't know how to apply. They don't have a team that's dedicated to looking at the research. So when PPP came out, a lot of folks didn't get to apply for it because they're just not ready to apply for it. And meanwhile, those that are ready immediately grabbed up a big chunk of it. So the question to the group is, are you going to dedicate some of your resources to start looking into what might be available, what information you need to provide? Have you worked with the state or national government in terms of if you want that funding, what do you need to do? Prepare for that now. So just in case in the future, if you don't need to use it, great. But if you do, you're ready for it.
Yeah, I completely agree. David, do you want to?
Yeah, Rachel, since you like cash flow, so talk about both ends of the private equity business. So on the one hand, raising capital, on the other hand, deploying that capital into businesses where you can generate growth and returns and so forth. Which of those gives you more food for thought in the current environment? And how do you best prepare that end of the business for what may be ahead in the next 12, 24 months?
Absolutely. And both sides are pretty interesting right now. I'd say maybe first on the capital raising side, you've seen, I mean, we've gone through years of just so much money pouring into private equity, VC, hedge funds, all sorts of things. And we're at a point now where that's really slowing on the fundraising side. And the main reason, of course, is the biggest investors, pension funds, endowments, big money managers, they are upside down in their capital allocation. They had so much in private equity that when their public equities really tanked and went down, all of a sudden, even though private equity is performing well, their asset allocation is completely out of whack. And so you're seeing some managers, some limited partners selling out of positions, not because they want to, because they have to. And you're seeing on the fundraising side, a lot having to pull way back saying, I can't deploy this year, or wait till next year, or tell me earlier in the year so I can get your allocation in, or they're only re-upping for existing fund managers and not looking for new. So we can see it taking fundraising, longer than usual, and then maybe people aren't hitting the target that they're hoping for. But that being said, there's still so much capital in the market, so much dry powder when it comes to equity and debt, and there's a timeline to deploy that. Usually it's 4 to 5 years after raising. So we view really continued M&A for the foreseeable future. It's just hopefully the market dynamics will result in more normalized valuations, driven by the growth projections, maybe a little bit more muted compared to up and to the right that we were seeing, 2 years ago on paper. And then obviously interest rates and availability of debt capital. It's interesting. You're not seeing that as much in the mid-market today as you are in the public markets. It hasn't trickled down as much, and sellers of companies are waiting often or putting things on hold. But hopefully we do enter a more kind of responsible era of investing over the next few years. while still being able to deploy that capital.
Yeah, thank you so much for that. And speaking of, interest rates and the current market trends, Cameron, I wanted to ask you, I know you spoke about interest rates before, and have, looking back in the past we were having a conversation before on, we were so happy we got our houses when there was a low interest rate and how that would be nothing we could, afford now. And, now with inflation being so insane, it's, especially in LA, right? I think when people make pasta and use 8 eggs, everyone's like, oh my God, so with inflation being so high and interest rates just increasing, were we spoiled in the past, or is this kind of the new normal that we should expect going forward?
We were spoiled.
You're spoiled. Got it.
So, like I said, the things that contributed to interest rates being at zero interest rate policy were crisis levels, the global financial crisis and the COVID crisis. And while I do expect a slowdown and I do expect inflation to come down to normalized levels, I don't think we get back to that zero interest rate policy that you saw once before. Now, anything could happen. And what I've learned in markets over the last 15, 20 years is that you don't bet. I mean, you don't guess what's going to happen. So you just prepare for what's going to happen in the future and do your best with it. But to expect another crisis to bring rates back down to zero and hope for that, I think is a foolish thing. So I do think that we've gotten used to interest rates being at zero, but we've got to get used to, we don't have to get used to inflation being at 6-7%. So inflation will come down, and those year over year numbers, you're already seeing that come down from the 8s that down to 5-6%. They're going to continue to come down just because year over year, those numbers will not be as high as they once were. So we're going to see us get back to very close to that the Fed's target level of 1 to 2%. And we're going to be able to thrive through that. So I don't see necessarily, inflation remaining at these elevated levels and therefore Fed funds coming, staying at these 4.5%. I do see Fed funds coming down to the 2.5 to 3% once they finally settle, and that's going to be 2 to 3 years down the road. One thing that you look back at, and one thing that you look at Powell as what he said in the past, and what he's trying to avoid the mistakes of his predecessors. If you look back in the 60s and 70s, a lot of times people think that in the 60s and 70s they were asleep at the wheel. They weren't actually asleep at the wheel. What happens was they made a mistake, and what they did was they tightened monetary policy up to 13%, and inflation started to come down. And when it hit 3%, they reversed course. They got afraid of what happened in the economy and job losses and recession, and decided to reverse course. Inflation then began to shoot back up, and because it began to shoot back up, they had to tighten monetary policy. You had Volcker tightening monetary policy, and rates went up to 22%. Powell is basically saying that, okay, during that period, once inflation exceeded 2%, we were above 2% for about 20 years after that. I want to make sure that we're not going to be in that sort of environment. So that's why you're seeing rates as high as they are. And a lot of folks think that they're already too high. They're going to remain that high because what he wants to do is make sure that we don't get in that situation where inflation reverses course, and now we got to shoot rates up to 7-8% to accommodate. So we've gotten used to the zero interest rate policy. I don't think we'll get back there. I think we're going to continue to overcome, but we do have a little bit of a period of I would say, pain. And right now, and part of the reason is Powell wants to break the economy. And break the economy, again, doesn't mean taking us up to 12% unemployment. It means 5% unemployment from 3.4% unemployment. And that means 1 to 2 million people across the US lose their jobs. But on the other side of that, we will see the Fed has plenty of dry powder to bring rates down. They're up at essentially 4.5%, and what we'll see to be 5% by expectation. They'll have enough dry powder to move it down 250 basis points to move it down to 2.5. So we've gotten used to too much, but we've got some room to move down.
Quick sidebar question, if I can. The economy is so much more complicated now than it was 20 years ago, even 10 years ago. There's so many pockets of individual areas, so many different attributes that are different now versus prior economic cycles. Do you think the tools that are used to manage the economy are still relevant? Interest rates at the national level, quantitative easing, pick which one you're talking about, but do you think those tools are still relevant today as they were in times gone by?
They are not as relevant as they were in the past. They're still relevant. They still have an effect. You're already seeing the Fed tighten monetary policy, but what we do know is that it takes about 12 to 18 months for those moves to actually take effect on the economy. So the tools that we've used, and they've tightened monetary policy as faster than they ever have, as far as from the bottom to the current levels, from the start of the tightening to where they are. So that 5% in 1 year was the fastest move that we've seen. But what I'll say is that the tools will work eventually. And the tool that they're using is to try to break certain parts of the economy, certain industries, in order to bring that unemployment rate up to 5%. So it's going to work, but the question is, when will it work, and how much will it work? So I don't think it's especially with what they did with quantitative easing and the balance sheet that they have, that those factors are going to work the way that they did once before, but they are going to eventually work.
Yeah, thank you.
And Rachel, we were talking about earlier the pandemic and, how it's influenced the economy and the growth recovery. And do you think that we'll ever get back to that pre-pandemic level of, what it was like before, what's the expected timeline for something like that?
That's a tough one.
Yeah.
I would say it depends on the sector and the industry and how impacted they were. And we invest across all sorts of industries. So it's kind of fascinating to see how different ones perform and behave. Logistics, for instance, has done incredibly well through and post-pandemic. And only now we're seeing both tailwinds and headwinds, still tailwinds in many areas of logistics, but headwinds in freight forwarding, for instance. In some of our business services companies, we're seeing softness in and commitments from clients on projects. Maybe it's shorter duration or certain chunks that maybe they eventually spend as much, but it just takes time to get that out. We have a birdseed company, and believe it or not, this country has a ton of very passionate birders who discovered even more so their passion during COVID and are committed to it. And so that business we've seen triple and is continuing to perform. So it's sector by sector. There's so much noise still in the numbers, can be based on supply chain issues and supply demand dislocation and all sorts of things that I think we look at this and say it's probably going to take another 2 years for things to settle out and to be able to really say, what is a sustainable, underwritable level of earnings that we can really get behind, because some look great and some don't. And from an investment standpoint, it's really interesting opportunity and challenge to invest in this environment, because again, you want to continue to deploy capital and look for opportunities, but it takes more to really cut through that noise and understand what the base is. I think for founders of businesses that want to partner and want to get liquidity or help with growth or whatnot, there's a level setting too that needs to happen in their mind to come out the right door on what that is. But I think we still have a little ways to go. And unlike, 2007, where it was really the housing crisis or this, I don't think we can call it just a pandemic. There's so many factors at play here. And there's the pandemic, there's the Ukraine, Russia, there's the inflation issues, the supply chain noise, there's labor challenges and shifting attitudes around work and environments. There's so many factors at play that I think the most important thing, again, is for companies to have those management teams that are really, really prepared to just deal with a myriad of things that are being thrown at them.
Yeah, thank you.
Stephen, coming to you, maybe talk a little bit about the workforce and the labor situation that, again, not dissimilar to the supply chain logistics that we talked about, where, last year there was a significant blockage in just finding good people, to your point, Rachel, finding good people to fill vacancies and roles and so forth. And the question there is, how do you see that shaking out from here on, next 12, 24 months, how does that contribute to the broader economic environment? And it's interesting because, from a labor perspective, we're obviously all here in person. We've got folks online as well. There's still a little bit of a feeling out where are we going to land with labor being in person versus remote. What does that mean for real estate? What does it mean for travel operators? And I love these conversations because everything's interconnected, and it's highly complex, and there's not necessarily a right or wrong answer. So with that, what's your perspective on where the labor markets currently are and what the outlook for those would be?
The short answer is who knows?
There you go.
I think to echo what Rachel was saying is it depends on the sector, right? So this morning we actually had our annual economic forecast with LADC, and we were reporting that the unemployment rate for LA County has recovered quite a lot. During the first 2 months of COVID, LADC did a report in 2021 in January, and we found in the first 2 months of COVID, March and April, Los Angeles County lost 780,000 jobs. I'm going to sit with that for a second. 780,000 jobs. That's the size of most major US cities and regions, right? It took us over 2 years to get that number back. So right now we're still 25,000 jobs short of where we were before the pandemic. But the recovery hasn't been the same. It depends on the sector. As you can imagine, hospitality, food services, accommodation, because of tourism, has not returned. Personal care, laundry services, a lot of that has returned. Non-essential retail has returned. Motion picture and sound recording, another huge sector that was affected because of the shutdown, returned and actually went above and beyond what we were seeing before. So depending on the sector, you're going to see a lot of transition. Now, LA has not returned to where we want to be when it comes to tourism, because it's this is one of our major industries, right? LAX, as mentioning, has a lot of cargo that goes through. Additionally, we're the #1 origin and destination airports in the United States. So it means people getting on and off the plane. If you count JFK, if you count Atlanta, they surpass us with the number of passengers because they count the passengers that are transferring to another location. So people want to come to Los Angeles. They want to go see the Harry Potter ride. They want to go, to Melrose and different locations. But a lot of it is international travelers. We haven't seen that return. So as they're returning, this is where your question in terms of labor is going to be very important. A lot of folks are moving away from the hospitality and accommodation and food services as well. Can we get them back? Do we have to move towards, you've seen robot bartenders now, right? Some servers are now coming in by robots as well. So automation is going to change this. So there are a lot of different factors, and a lot of different industries are going to be completely transformed because of this. And we're not quite sure. And the last thing, just to close it out, is remote work is going to be a continued factor. Many professional service industry, they can go remote, but when it comes to direct services, again, hospitality, entertainment, it's hard to go remote, and you can't. So if we have the tourism coming back, how do we basically accommodate for this? Do we have a labor force that can sustain it? Do we have to train the next generation, or do we have to basically move people from Arizona to come here to take this? What does that mean? We don't know.
Yeah, it's extremely complicated, and I feel like so many businesses are still trying to figure out the hybrid world. Even, this meeting is hybrid, right? So we're all still trying to figure it out and see how it comes. David, did you want to ask? I think we're running short on time. Do you want to ask the last final question for everyone?
Sure. And then we're going to go, I think, to some Q&A.
Yes,
So
definitely.
some fun questions. I guess, and question directed to all of you, and maybe Rachel, since you're right here, you can go first. Just to close us out before we get to the Q&A, maybe some key takeaways that you have for business owners, for business operators, and things to be cognizant of as we all try to navigate what ultimately no one has a crystal ball, I think. So navigating those unknowns, some takeaways for owners and operators.
Yes, absolutely. No one has a crystal ball. I think what the last few years has taught us is to be prepared in any way that you can. And I think the best way we see our businesses doing that is getting the right talent around the table and building strong management teams. And in face of uncertainty, business owners could be more inclined to cut costs or cut their management team. But I think now is when, you might even consider bolstering that team, because there could be really great, valuable talent available. And I'd say, from my perspective, an area where particularly kind of founder-owned businesses maybe are a little weaker is just the finance role and capacity. And so, in my opinion, getting a great CFO who's forward-thinking and FP&A related and isn't just reporting what's in the rear view, but is a true business partner to the owner, to the CEO, and can help look around the corners and be proactive and establish KPIs. So you're not, 15 days after the month end and you close the books, shocked at something that happened, that it truly is someone who 15 days into the current month is, reading the key metrics and helping to navigate and go forward.
The takeaway, I would say, redefine your definition of recession. It's a slowdown. Those will happen. The economy will ebb and flow. Doesn't always have to be essentially a depression. A recession is when I've heard in the past, a recession is when your friend loses or your neighbor loses their house. A depression is when you lose your house. I don't expect us to have such a depression that we had in the COVID and global financial crisis. So redefine what you mean by recession and prepare accordingly.
Do your homework. Prepare. We don't know what's going to happen next, but if you have a resiliency plan, have a resiliency team, do your research. So when the time comes, you're ready to basically jump in.
Thank you for the plug. And I think at this point, if we want to go to the Q&A, thank you guys so much for answering our questions, but I'm sure a lot of people have questions for you all.
We have some questions from online. I'm going to start with one of those. What role does the ever-growing availability of data play in understanding the economic environment? And what data can companies arm themselves with to be best able to predict, adapt, and react?
Well, what I'll say is that there's a tremendous amount of data out there, and there are a tremendous amount of folks with different opinions. I mean, you've got 5 different people on stage. You probably have 5 different opinions about what's going to happen. I don't know if you can really figure out like, okay, if I pull these 3 pieces of data, and then I'll be able to know exactly when the next recession will happen, or I'll know when the market will reverse course. Again, like Stephen said, arm yourself with as much knowledge as possible and mitigate risk where you can, get certainty where you can. There's a tremendous amount of volatility in the market, a tremendous amount of uncertainty. If one of us knew exactly what was going to happen, if anyone knew exactly what was going to happen, they'd be on CNBC telling the world from their yacht. So arm yourself with as much data as possible, but don't get bogged down by how much data that you get, because then you get into an analysis by paralysis situation.
I'll add to that, compare your data sources. So our economic forecast today, our economists listed some numbers. I saw the UCLA forecast, they have a different number when it comes to the GDP for LA County. And I saw that another agency has a different number. So data can be interpreted differently. They can calculate different ways. So just again, get the information, compare, have the best information possible, and be flexible, because it's not gonna, data can be manipulated and presented in different ways. So do your homework, compare, do your best, and basically based on that, you make the best decision you can.
Well said.
Bear with me.
This is from the back row here. All right. We're not in the front row, but like Andy is. But so I'm Don Snyder, and I lead the firm's food and beverage practice. And so obviously food and beverage is near and dear to my heart. So because of the factors that you guys have already talked about, supply chain, labor costs, raw material ingredients costs, inflation for food and beverage has been in double digits over the last year. It's starting to decrease a little bit. What food companies are doing, there's increased pressures to obviously raise the prices on food, on food prices to basically offset the raise in the costs that they're having to pay. The big question to you guys, I'm going to ask you guys to put your consumer hat on. How much more can food companies increase their prices before there's huge pushback from us as consumers to even pay those prices?
Well, what I'd say is that right now, I mean, what you'll have to see is the wage inflation picture start to slow down before you do see a lot of pushback. You're still seeing wage inflation in the 3 to 4% range. Is it at the 11 to 12% range? No, it's not. But because folks are getting paid a little bit more, they're able to sort of navigate those. And those are necessities. Those food prices are necessities, unless you're talking about truffles or things like that. But those eggs that we saw a tremendous amount when we got that shortage. People were still looking for eggs. People were still looking to pay for eggs once they came through. So because we've seen that wage inflation cycle sort of perpetuate through, you haven't seen that pushback. When you will see that pushback is when you do see that that trend reverse course. Right now, because of, and we talked about it earlier, the regionalization of America and other economies, you're not seeing that. You're seeing folks actually being able to pay more, and you've seen job openings in the 10 million range. You see an unemployment rate of 3.4%. So I don't think yet you'll see that pushback, especially on the necessities, until you see that wage inflation trend reverse course.
Yeah, I completely agree. And I'd also say it depends on what the food product is. Is it the hottest new vegan, paleo, non-GMO, all natural snack that costs, $8 a bag and the bag is half full? Or is it something that's absolutely essential to feed your family and your kids? And those are two extremes, but people will make trade-offs and decisions. And if something gets too expensive, they'll trade down to something else. And we expect private label to do really well during this time period. But in our view, it depends. And for a while now, I mean, branded food has been such a hot space for investors to enter, and even really small companies, again, not necessarily profitable, but getting some sort of traction with consumers. So it'll be fascinating to see what happens to that market and the capital availability for that market.
A slightly different perspective, but similar to what Rachel was saying, it depends on the product, right? This food product. What we've seen is that consumer spending has been continued to, in 2022 at least, it's been pretty up there. But just in the first month, we've seen that number come down a little bit. And it's correlated, our economist been saying that because of COVID, because of the federal dollars that are available, because of a rise in wages, folks had discretionary spending they can spend. And because a lot of them weren't traveling and, kind of doing some of the things that they usually do before COVID, they were able to use those dollars and continue to buy, even though with the prices increasing, they were still willing to pay for it. However, looking at the economic condition the way it is, they're not quite sure. So all of a sudden, you see a bit more conservative aspect in terms of what they're willing to spend. So my view is, I don't know how long you have into pushing the prices, because I think folks are looking at it from a more conservative perspective, especially here in California and Los Angeles.
I know there's a couple in the audience, but I'm gonna do one more online. We're gonna try and be even. So is the national debt just an arbitrary number? Should we be worried about its size?
Yes, it's arbitrary. We shouldn't be worried about it. They're going to raise the debt ceiling. I mean, in this case, there might be a couple of issues just because you've got such a divided government. But at the end of the day, they will raise the debt ceiling. And what I think you'll see is Powell and Janet Yellen are going to try to take themselves out of that equation. But eventually, they're just going to say, "Come on, knuckleheads, get it together. We got to raise the debt ceiling, and we're going to continue to raise the debt ceiling to accommodate." If you look at the percentages, and I know people say, Japan, when they got to 120% of debt, now they got into this hyper or no inflation environment where rates wouldn't go up. A lot of these different things, there are so many different factors that affect what happens with the national debt that I think it's an arbitrary number, and they'll continue to raise the debt ceiling accordingly. But that's an opinion.
Hi, John Graff from the Reason Foundation. We're a public policy think tank, and similar question on the federal debt. California is also reporting $29 billion deficit. But on the federal debt, we're going over 100% of GDP. And we're pissing off our biggest borrower. So at what point do we have an issue where China is no longer buying US debt? And what's the trickle down from that?
Well, from the California side, that definitely when we have a debt, we don't have the ability to print money, right? So that's going to impact the way that we're going to spend. And so we're going to have to dive into a rainy day fund. And also it's going to impact our spending that's available, whether it's infrastructure spending, whether it's going to be spending on public schools. So it will have a direct impact on us. For the debt ceiling aspect, I would say ditto.
You know, I'll add to it just as far as pissing off the Chinese, as far as being our largest foreign holder, you still got the Fed. The Fed is there to save the day. And not only that, when you look at the US currency, the US dollar is still the world's mattress. It's still the world's reserve currency. If the global economy decides that the US dollar is no longer that world's reserve currency, that's when we have an issue. And with what we've seen with the Chinese yuan over the past year and the sort of the gamesmanship that the Chinese government plays, you won't see us as a global economy migrate to the Chinese yuan being the world's reserve currency. And so when you have those two factors, that's what I think contributes to, okay, if not only just the globalization of, okay, over in China, they have the earth metals, and we need those. But over here, we have the ag space that they don't have over there. So there's going to be some gamesmanship between both sides. I don't think there's a way to piss them off enough where they become a point where they're going to sell a bunch of US debt and actually have an effect on the economy that the Fed says, well, we'll just buy that from them.
Another online question for you. What are your thoughts around the diminished supply of workers in relation to the unemployment relative to interest rate adjustment? Do you think demand for workforce will be more inelastic based on how many people have left the workforce after the pandemic?
It's a small chance. There's a potential productivity issue that we have with the work from home economy. And it's partly in the remote economy as well. And I think that's another reason why you've had a lot of wage inflation from folks being able to demand more and look for other jobs and be able to move to other jobs and demand higher wages. So there is something that I would say as far as the demand for jobs. We still have job openings at 10 million. We still got unemployment at 3.4%. So I think that those factors are going to remain in place for the foreseeable future. But watch out for that productivity issue, that if we do continue to see low productivity at the same time as we have a high demand for actual productivity, that wages could actually continue to rise.
Yeah, and I think it goes back to your point too about where are the jobs that are open? Are they in the services sector? Are they in the tech sector? Where are they, and what is the demand for them, and what is the alternative with our kind of digital economy as well comes into play.
I got a question for the audience really quickly. For those who are hiring, how many are you still hiring, just at all? Thank you.
I was looking at the numbers that we saw today earlier in the economic forecast. We know that the employment rate for Los Angeles has gone down to about 4.4% in December. It's now creeping back up to about 4.5%. So to your point, right, the unemployment number is still there. There's still jobs available. We've been looking at job posting number as well. It's been going up actually all throughout 2022. Just recently, it's dipped a little bit, but there's still going to be that opening. The labor force, in terms of as folks are not wanting to come back to the workforce, that's also sometimes related to the excess cash and also the public funds that are available through their savings and through some of the rent abatements and eviction abatement that's been happening as well. But those are going to change at certain points. How do you sustain your lifestyle? How do you sustain your family? So I think those will all come to play in the next few months, if not few years. So, and the last thing is we don't talk about it enough, but the impact of automation in the future of our workforce and what that means. I think that's something that we have to look very carefully at.
I just want to say one thing for the virtual audience. I don't know if you can see the physical audience. So many people in this room raised their hand when that question was asked. So I just want to make sure they could know that.
Hi, I'm Ruby. So I work at the terminal for a long time down at Port of Los Angeles. I just remember the way the business is run is really outdated with the union, and I can see why somewhere else surpasses. How do you see us overcome that obstacles? Because, as you know, with the union, you can only do certain things. But I already can see that the way we operate was not efficient. And as you say that somebody surpasses, I'm not surprised. And the last time I worked there was a long time ago, and I saw that happening.
I'll say that the reason why New York, New Jersey surpasses is not because they're more efficient or more technologically advanced than we are. It's just because we're going through a labor negotiation right now, and it's just basically a just in case we have a dispute, then they basically don't want to be stuck here. New York, New Jersey also has labor union issues on their own as well. And so this is going to be across the board for all the United States terminals. How we overcome it, we're already moving forward with it. We just have to basically be bold to be able to move forward with it. They've been negotiating with our labor partners as well, talking about the need for changes. And so, for example, one of the issue is basically when the trucks are coming in, they just imagine a ship comes in with, 3,000 container or 8,000 containers. They get dropped into the terminal. A truck will pick it up. A local yard trailer truck will basically come in, put it in the stack, and they stack everything up. Another truck have to come in from outside to pick up that box. And they said, oh, I don't want the top box. I actually want the bottom box. So you have to move 3 boxes to get to it. So they put it in the truck goes out. The next box said, hey, you just moved my box to the very bottom. I needed that. So then they have to move everything around, and basically it becomes a very inefficient system. So right now what they're doing is they're coordinating with, and at the Port of Los Angeles, there's 7 terminals, and the Port of Long Beach, I think there's like 7 or 8 terminals. So altogether there's about 14, 15 terminals that are operating separately, and they all had their separate systems. So imagine that's coming in, like I just picked up a box from TTSI in Long Beach. They have to come back and go to Evergreen. But guess what? They have a chassis that's not belonging to one or the other. So they have to change the chassis before going back. So these are the issues that are involved. So what they're trying to do is basically have a centralized appointment system so they can make an appointment and get there. So before they even get there, the RFID tags it and they go in there. It's like, oh, we have your box waiting for you. Here you go. Next box. We know you're coming from an hour ago. We know you're stuck in traffic. So here's your next box. So it moves out more efficiently. They're also having a centralized chassis pool system that they're developing right now. So regardless of basically whether you have a China shipping chassis or you have a Costco chassis, you can come in and you can basically pick it up. So these are the things that they're moving forward. So I want to let you know that there are efforts, but the thing is, it's such a large system. It's not just because of labor. It's basically all the complexity that's there that's making it. So we're making headway, and we're actually making headway more so than a lot of the other regions because we have to. But what we need are the financial infrastructure dollars to come in, and what we need is to fight for our fair share. So the federal government's not taking our tax dollars that we're paying into the system and subsidizing it at the East Coast. So I'll say that.
Thank you.
Sounds like you have some great people who make really wonderful things happen down at the port. And I think we're getting ready to wrap up here. And with that, I want to close with a couple of thank yous. And one of them, oh, we have one more question. Okay, let's go. One more question.
You sure?
Since
it's a David to David, maybe I get
I'll let it slide.
a pass. Okay. Maybe. So David Sternberg, I'm a partner in our audit practice with the focus in private equity. My question is about debt covenants. So it's going to be to Rachel and to Cameron. And so increasing interest rates, economic headwinds, obviously certain sectors are under a bit of pressure, as we were talking about earlier, probably putting some pressure on debt covenants. Rachel, for some of your portfolio companies, maybe.
Cameron, you've maybe seen clients that are coming under some pressure. So how is that on both ends of the spectrum? How is that impacting, Rachel, your relationship, Endeavor's relationship with banks? And on the banking for third side, how's that impacting your relationship with clients? And I guess if you want to role play the negotiating table here, feel free.
It's really interesting because you have the combination of potentially performance issues with companies as well as higher interest rate costs. And it's not just higher interest rates for new capital structures. There is a LIBOR floor or a SOFR floor that companies sign up to that does fluctuate. Thankfully for our firm, we have very low leverage on our businesses and we tend to work with commercial lenders, so lower rates. For private equity in general, private equity firms are usually putting 4 or 5 times leverage on businesses, which means 4 times EBITDA. It's kind of a measurement of leverage, that much debt. So if EBITDA is 25 million, there could be 100 million or 150 million of debt on a company. If performance goes down slightly and interest rates go up, then you can have a real problem, both on your debt covenants, your leverage covenant, and on your fixed charge covenant with your interest rates. And so it can put you into a situation where the company's still healthy and at your old interest rates, you actually would be in compliance. But it's interesting because we're seeing lenders use that as a tool to increase interest rates. If it was a credit facility that was done before, these rising interest rates, they're using it as an opportunity to reset, which is slightly unfortunate. So I think what we tend to try to do is really treat our lenders as true partners all the way through and build long-term relationships with them. So, ideally there's some middle ground, there's some kind of sharing of the pain, and it's not a risk the business type decision. It's what's the best outcome for both parties in the business. I will say just an anecdote. I was talking to a company CEO, a different private equity backed business. The transaction for the business was a slightly over $1 billion transaction, about 6 times leverage was put on it. And they're based on interest rate fluctuations, their annual interest went up by 30 million a year. So now he has to manage growth in that environment. He's like, I had 4 growth initiatives, now I can only do 1 because of that. And so it goes back to what is a healthy capital structure too. And hopefully this environment shift will change people's perspectives on valuation and leverage and what's responsible, appropriate for enduring businesses. And I think private equity's gotten a bad rap for not abiding to that and pushing the leverage level. And hopefully this gets us to a healthier, more sustainable long-term environment.
And I'll be really quick. I'll say you'll see on the bank side a lot more required hedges. You'll see a lot more required swaps, required caps to control that interest. Yes, you'll see a widening of interest rate or loan spreads, but in order to take that rising rate and rising environment into account, you'll see a lot more required hedges.
There's fees on those hedges.
There's money to be made. So David, I got one more question. So by the way, Rachel, I agree in collaborating with your lender. We invite our lender to speak at our panels. Anyway, I have a question for Stephen, just to kind of bring us home, hopefully on a positive note. So GHJ is headquartered here in Los Angeles, right? The preponderance of our clients' commerce generates from Greater Southern California. You have a unique position in your role at the LAEDC and World Trade Center LA and all these different roles that you have to have a really good view on what's happening in the future. There's some clear things that we all know about, like the Olympics. World Cup's going to come here. There's a bunch of different things that are coming our way. What are the 3 most exciting things that you're most excited about for Los Angeles and Southern California?
One, besides Olympic and Paralympic Games, World Cup, did you know we're bidding for the 2032 Rugby World Championship Cup here too, and the female rugby championship? So we will basically bring other sports here. So that's very exciting. What I'm also excited about is the continued growth of the diversity of the sectors here in Los Angeles. The reason why we're able to withstand many of the the fluctuations in the economy is because we're not dependent on one or two single sectors. Here, whether it's aerospace, whether it's digital media entertainment, whether it's ocean economy, whether it's sustainability, all those things are basically thriving here. And so there are going to be certain sectors, like I was mentioning before, personal care, non-essential retail, accommodation that suffered a little bit, but overall still going to be very healthy. Second, I would say the exciting thing is also not only diversity of industries, but diversity of people. This is what makes Los Angeles so strong. Everybody's talking about DEI. Everybody's talking about equity when it comes to female representation on boards. We're already leading in that, right? So how do we make sure that this is going to be the national model, international model moving forward, and everybody's looking towards us? Speaking of leadership, the third part I'm very, very excited about is that a lot of folks look at Los Angeles and they use our environmental policy against us, basically saying this is the most stringent and most restrictive environmental regulation in the United States, if not the world. Many cases it might be true. However, it's also creating new industries and new sectors because of the push for electric vehicle usage. Recently, World Trade Center Los Angeles partnered with a company called VinFast in Vietnam to open up their North American headquarters here in Playa Vista, with 1,000 jobs that could be created right here. I mean, no offense to our partners in other parts of the States, but good luck, Missoula. Right. So there's a reason why, because we've invested heavily in terms of what the infrastructure is going to look like, allows us to attract these industries. So I think between diversity of people, diversity of industry, and also our specific policies that have been pushing forward, it's going to allow Los Angeles to continue to thrive. Guess that's coming back. Yeah. I wish to Los Angeles.
And a wonderful note to end on. Thank you. I do want to just close us out by, first of all, thanking our panel. So hands together, please, for our panelists. We do have some gifts, I believe, that our team will be handing out. It's actually a crystal ball.
Cloudy one.
Cloudy one, yeah. But thank you also to our fantastic marketing team for putting this event on. Very much appreciated. It's been super having the discussion here in our office in LA, as well as with the online folks joining us. The event is recorded, so it will be posted on our social media page, on our website as well. So folks can catch up there. There'll be blogs on the event recapping also. For folks that are here in LA, we have some food and drink, so please join us afterwards for some networking time. For folks online, thank you for joining. Have a great evening, and we'll see you all soon. Thank you very much.
Yeah.